Good afternoon. My name is Roger Sherman and I'm the Chief of the Wireless Telecommunications Bureau. On behalf of the Bureau and the Incentive Auction Task Force, I want to thank you for joining us this afternoon. Today's webinar provides an overview of significant updates the Commission recently made to its so-called competitive bidding rules. These updates, which were adopted by the Commission in July of this year, recognize the challenges new entrants face entering the wireless industry, especially into a marketplace in which more than 95% of existing customers are served by the four biggest providers. Simply put, the previous rules were a byproduct of an earlier time and had not been adjusted since 2006. Although the new rules were designed to provide innovative, smaller companies the opportunity to build wireless businesses to benefit consumers, the Commission also saw an opportunity to enhance the transparency, efficiency, and integrity of FCC auctions into the future. Bureau staff will explain how the new rules allow for enhanced flexibility, at the same time as making clear that eligible small businesses cannot be used to obtain bidding discounts for large corporations. Some of the rules that we will discuss today apply to all parties. Others are targeted to address the particular needs of small businesses and rural service providers. Taken together, they reflect common sense reforms that promote several core goals of the Commission, including fostering competition, both during the auction process and in the post-auction wireless marketplace, preserving auction integrity by ensuring that the rules and processes are transparent and fair to all parties, and maximizing participation by providing small businesses, rural telephone companies, and businesses owned by members of minority groups and women an opportunity to provide spectrum-based services. Of course, we must also maintain adequate safeguards to prevent unjust enrichment. The new rules reflect the significant input we received from the public and industry stakeholders and fulfill the Chairman's stated goal of having updated, common-sense rules in place before the broadcast incentive auction. Speaking of the broadcast incentive auction, as you probably already know, the Commission recently announced that the filing window for forward auction participants opens on January 14, 2016 and closes on January 28, 2016. It's our hope that this webinar will help potential applicants prepare for the world's first ever broadcast incentive auction. We encourage you to ask questions to make sure you understand how these rules may apply to your planned participation in the incentive auction or future auction activities. Bureau and Incentive Auction Task Force staff will tackle as many questions as possible today, but will be available going forward should you have additional questions. Appropriate contact information for such inquiries will be available at the end of this presentation. Thank you again for your participation.
Hi, my name is Sue McNeil, and I am a Special Counsel in the Wireless Telecommunications Bureau. Thanks so much for joining us today. Before we get started, I wanted to briefly address a quick housekeeping matter and walk through our agenda for today. As noted in this first slide, you need not make an ex parte filing based on your participation in today's program. Next, let's quickly review the agenda. The first half of this program will cover changes to our Part 1 rules that apply generally to everyone. We will discuss topics ranging from joint bidding to prohibited communications, commonly controlled entities, and the former defaulter rule. After that, we will focus on rule changes that apply to designated entities, or DEs. We will cover DE eligibility, a new bidding credit for rural service providers, as well as the cap on the total amount of bidding credits that any DE may receive. After that, we will take a short break to review any questions that we have received, then jump back online to provide answers. We invite you to submit questions on a rolling basis during the course of this webinar by email. The email address is noted at the bottom of each slide. We also ask that, where possible, you submit questions as you think of them rather than waiting until the end of the presentation. This will help ensure that we have an opportunity to answer the greatest number of questions possible. Finally, we ask that you identify yourself and your organization in the text of your email. Without further delay, I will turn things over to Karen Sprung, an attorney in the Competition and Infrastructure Policy Division, who will walk through the general Part 1 rule changes. Afterwards, Howard Davenport, an attorney in the Auction and Spectrum Access Division, will discuss changes pertaining to DEs. Karen, take it away.
Thank you, Sue. As Roger noted, the Part 1 report and order reflects profound changes that have occurred in the wireless industry over the last decade. The Commission's July decision modified the competitive bidding process and compliance rules to increase transparency and efficiency, as well as to protect the integrity of the Commission's auction process. Chief among these changes is a prohibition on joint bidding, as well as related changes to the rules regarding prohibited communications and multiple applications filed by commonly controlled entities. These rule changes will still afford opportunities for non-nationwide providers and designated entities to pool their resources for auction purposes, but the new approach is more transparent and easier to administer. The Commission also amended its rule governing former defaulters to narrow the focus of the rule and to minimize administrative and implementation costs for bidders. All of these modernizing rule changes will be in effect for the upcoming incentive auction. In this rulemaking, the Commission sought to prohibit certain arrangements involving auction applicants relating to the licenses being auctioned that address or communicate bids or bidding strategies. These include arrangements regarding price and specific licenses on which to bid, as well as arrangements relating to the post-auction market structure. Because joint bidding and other competitor collaborations might reduce competition between participants post-auction, such arrangements raise the risk that spectrum licenses acquired at auction could be distributed in a manner that would harm the public interest. Joint bidding arrangements between auction applicants are therefore prohibited. The prohibition against joint bidding also extends to bidding arrangements between nationwide providers in which one or more of the nationwide providers is not itself an applicant in an auction. In addition, joint bidding arrangements between nationwide and non-nationwide providers are prohibited in circumstances where any one of the parties is an applicant. We note that the term non-nationwide provider refers to any provider of communication services that is not a nationwide provider. However, as will be discussed shortly, eligible non-nationwide providers may pool resources to form a joint venture or consortium and apply to participate at auction as a single bidding entity. To promote clarity and certainty and to achieve our stated goals, the Commission refined the definition of joint bidding arrangements to include arrangements that relate to the licenses being auctioned and address or communicate, directly or indirectly, bids and bidding strategies, or post-auction market structure. These include, among other things, arrangements regarding price or the specific licenses on which to bid. The Commission clarified that the prohibition on joint bidding does not encompass agreements that are solely operational in nature. Specifically excluded from the definition of joint bidding are agreements that address operational aspects of providing a mobile service, such as agreements for roaming, spectrum leasing and other spectrum use arrangements, or device acquisition. When an applicant certifies to its compliance with our competitive bidding rules, it is certifying that any operational agreement that it may have does not involve a shared bidding strategy and is therefore solely operational. Similarly, any agreement for the transfer or assignment of licenses will not be regarded as a prohibited arrangement, provided that any such agreement meets certain criteria. An assignment or transfer agreement will not be prohibited unless it both relates to the licenses to be auctioned and addresses or communicates directly or indirectly bidding at auction, including specific prices to be bid, or bidding strategies, including the specific licenses on which to bid or not to bid, or post-auction market structure. In addition, agreements between an applicant and another entity solely for funding purposes, that is, with no agreements with regard to bids, bidding strategies, or post-auction market structure relating to the licenses at auction, are not prohibited joint bidding arrangements. Because of the potential benefits to smaller providers and for purposes of promoting competition within auctions and in the marketplace, eligible non-nationwide providers may enter into agreements to form either a consortium or joint venture. Specifically, our revised rules permit designated entities to form bidding consortia to participate at auction as a single entity, provided every member of the consortia qualifies as a designated entity. Our rules also allow non-nationwide providers to form joint ventures to apply to participate at auction as a single legal entity. Note, however, that non-nationwide providers may participate in only one joint venture in an auction, which shall be the exclusive bidding vehicle for its members. A designated entity can participate in only one consortium in an auction, which shall be the exclusive bidding vehicle for its members. Finally, as I already mentioned, nationwide and non-nationwide providers are not permitted to form a joint venture to participate in an auction. When it adopted the prohibition on joint bidding, the Commission substantially modified its existing rule that prohibits applicants from certain communications regarding bids or bidding strategies, including post-auction market structure, between the deadline for filing applications and the post-auction down payment deadline. First, the Commission made the rule applicable to communications between more parties. Specifically, the Commission made the rule applicable to communications between any applicants in the auction, rather than just between applicants for licenses in the same geographic area. The Commission also made the rule applicable to communications between any applicant and any nationwide provider. Finally, it made the rule applicable to communications between any nationwide provider that is an applicant and any non-nationwide provider. Second, the Commission removed prior exceptions to the prohibition that were premised on the existence of particular bidding agreements that are no longer permitted under the prohibition on joint bidding. Third, the Commission incorporated communications relating to post-auction market structure into the language of the rule, reflecting prior staff guidance that communications regarding post-auction market structure might disclose bids or bidding strategies. Fourth, by referencing communications relating to pre-existing agreements that do not violate the joint bidding prohibition, the Commission made clear that the rule should not disrupt pre-existing operational agreements, such as agreements regarding roaming or agreements regarding the sale or transfer of existing licenses. The Commission also expressly noted that requests solely for funding purposes and not with regard to bids, bidding strategies, or post-auction market structure do not violate the rule. Finally, the Commission's rules now prohibit an individual from serving as an authorized bidder for more than one auction applicant. We also note in this context that the Commission's rules require that an applicant provide a brief description of and identify each party to any agreement relating to the licenses being auctioned. The subsequent guidance on prohibited communications public notice with respect to the incentive auction provided additional discussion and clarification that the rule is not intended to affect non-auction related business as usual. The Prohibited Communications PN made clear that the rule's incorporation of pre-existing operational agreements that do not violate the rule is not intended to preclude ongoing negotiations and new agreements that do not otherwise violate the rule. The Prohibited Communications PN also explains that communications covered by the prohibition include the types of agreements barred by the prohibition on joint bidding. That is, to be subject to the prohibition, the communications must both relate to licenses being auctioned and convey bids or bidding strategies or post-auction market structure. So the rule's incorporation of post-auction market structure as a factor does not mean that all communications relating to post-auction market structure are prohibited, only those that also relate to the licenses being auctioned. The Prohibited Communications PN further clarified that discussions about the technical standards applicable to the licenses after the auction does not by itself raise post-auction market structure issues within the rule's concern, absent discussions about who will obtain particular licenses through the auction. It also explained that discussions in connection with FirstNet's RFP that involve post-auction market structure will not violate the rule, so long as they do not relate to licenses being auctioned. In this rulemaking, the Commission tackled the issue of commonly controlled applicants. First, it codified its long-standing practice of prohibiting the same individual or entity from submitting multiple FCC Form 175 applications in any commission auction. This prohibition will minimize unnecessary burdens on the Commission's resources by eliminating the need to process duplicative, repetitious, or conflicting applications. This rule will also reduce the risk of undesirable strategic bidding by preventing a party from placing bids through two bidding entities. Consistent with the prohibition on joint bidding agreements, the Commission also determined that it will, as a general matter, only permit an entity to participate in a Commission spectrum auction through a single bidding entity. This means that the Commission will not permit the filing of applications by entities controlled by the same individual or set of individuals. This restriction will apply across all FCC Form 175 applications in a particular auction without regard to the licenses or geographic areas selected. The Commission will determine common control for purposes of this prohibition using the controlling interest principle set out in Section 1.2105A4 of the Commission's competitive bidding rules. Under this newly adopted definition, a controlling interest includes individuals or entities with positive or negative de jure or de facto control of the licensee. The Commission established an exception to address the unique circumstances arising out of the cellular B-block settlement process regarding rural wireless partnerships. The exception recognizes that partnerships and their component rural telephone companies may each want to participate in Commission auctions with different bidding objectives, and that the unique ownership structures of such partnerships should not be an obstacle. Under this limited exception, each qualifying rural partnership and its individual members will be permitted to participate separately in an auction. For purposes of this rule, a qualifying rural wireless partnership is one that was established as a result of the cellular B-block settlement process. No nationwide provider is a managing partner or managing member of the management committee, and partnership interests have not materially changed as of the effective date of the Part 1 report and order. A partnership would qualify if it is a partner or successor in interest to a partner in a qualifying partnership, does not have day-to-day management responsibilities in the partnership, holds 25% or less ownership interest, and certifies that it will implement internal controls to insulate itself from the bidding process of the cellular partnership and any other members of the partnership, other than expressing, prior to the deadline for resubmission of short-form applications, the maximum it is willing to spend as a partner. To be clear, the prohibition includes those entities that are under common control. An applicant that has a disclosable non-controlling interest holder in another applicant can still participate separately in an auction, provided that each applicant certifies that it has established sufficient internal control procedures. Such procedures must preclude any person acting on behalf of the applicant from possessing information about the bids or bidding strategies of more than one applicant, or communicating any such information to anyone acting on behalf of another applicant. The Commission also addressed industry requests to modify its former defaulter rule. Consistent with the waiver it granted prior to Auction 97, the Commission revised its former defaulter rule to exclude from consideration of the definition of former defaulter any cured default on a Commission license or delinquency on a non-tax debt owed to a federal agency for which any of the following criteria are met. The notice of the final payment deadline or delinquency was received more than 7 years before the relevant FCC Form 175 filing deadline. The default or delinquency amounted to less than $100,000. The default or delinquency was paid within 2 quarters, that is 6 months after receiving the notice of the final payment deadline or delinquency, or the default or delinquency was the subject of a legal or arbitration proceeding and was cured upon resolution of the proceeding. Thus, Any applicant falling into one of those 4 categories need not certify to being a former defaulter and need not pay an upfront payment that is 50% greater than non-former defaulters. In addition, the Commission also narrowed the scope of the individuals and entities evaluated under the former defaulter rule. Specifically, it limited the former defaulter rule to those individuals and entities that have positions of control over the auction applicant or licensee and may be able to influence the ability of that entity to fulfill its auction-related financial obligations. By narrowing the scope of the former defaulter rule to attribute only defaults or delinquencies of controlling interests, the Commission ensured that the underlying purposes of the rule are met while minimizing costs for auction applicants.
Hello, my name is Howard Davenport. I'm an attorney in the Auctions and Spectrum Access Division here at the Federal Communications Commission. I want to thank you for this opportunity to discuss with you changes that the Commission made to its designated entity rules. With regard to provisions for DEs, or designated entities, the Commission took a number of important steps to benefit designated entities. The next slides walk through the main changes to the Commission's rules. The big news for DEs is that the Commission eliminated the attributable material relationship, or AMR rule, which required a per se bright line attribution of revenues to a DE applicant licensee when the DE had even a single lease of 25% or more of any of its spectrum licenses. The Commission also abandoned the corresponding policy that required DEs to be primarily facilities-based providers with each of its spectrum licenses. Instead, the Commission affirmed its application of the existing controlling interest standard found in Section 1.2110 of the Commission's rules and adopted a 2-pronged test which will use a totality of the circumstances analysis to evaluate an entity's eligibility for and retention of small business benefits on a license-by-license basis. Here is how the 2-pronged test will work. Under the first prong, the Commission will use its controlling interest standard and affiliation rules to determine what revenues are attributable to the small business for the purposes of meeting the small business size standard. Under the second prong, the Commission will evaluate whether a small business is entitled to benefits based on whether it will maintain de jure and de facto control of the particular license at issue under the terms of any use agreements for each license. So, for instance, if a DE has a spectrum use or other agreement that calls into question whether the user's revenues should be attributed to the DE for that particular license rather than for its overall business operations, the DE may be ineligible to acquire or retain benefits for that license. Staff will carefully review investor agreements that raise concerns about who's calling the shots in order to ensure that the DE retains control of spectrum in its business. The totality of the circumstances approach adopted in the Part 1 report and order will also provide the Commission with the opportunity to determine a variety of issues, such as if an entity with a non-controlling interest in more than one designated entity has created the type of relationship with the DE to warrant attributing the non-controlling interest revenues to the DE. Examples include management services agreements, rights of first refusal, discriminatory loan terms, etc. The continued prevention of unjust enrichment remains a priority for the Commission. In keeping with the other reforms it made, The Commission therefore adopted a new attribution rule to serve as an additional safeguard to prevent ineligible entities from benefiting from bidding credits to which they are not entitled. Under the new rule, a disclosable interest holder in a DE applicant or licensee will become attributable on a license-by-license basis if it uses more than 25% of the spectrum capacity of a license awarded with bidding credit during the unjust enrichment period. So, let's unpack this rule. First, who is a disclosable interest holder, DIH, for the purpose of this rule? Under the new rule, a disclosable interest holder is a holder of 10% or greater interest of any kind in the applicant as defined in Section 1.2110, subparagraph C2II uppercase J. If a DIH exceeds the spectrum use limitation by having an agreement of any kind to use more than 25% of the spectrum capacity for any particular license that is won with a bidding credit, then that DIH's gross revenues, or in the case of rural service providers, the subscribers, become attributable to the DE on a license-by-license basis. A rural service provider, or RSP, may have a use agreement with a DIH without having to attribute the DIH's subscribers if the DIH is independently eligible for a RSP credit and the use agreement is otherwise permissible under the rules. The rule basically recognizes that a DE may have business reasons to make a use agreement on some licenses and not others, but those agreements should not necessarily mean the licensee should not be entitled to bidding credits on other licenses. The Commission also, for the first time, expanded the definition of designated entities to include eligible rural service providers and adopted a 15% bidding credit for eligible providers. In order to be eligible, an RSP must, 1, provide commercial communication services to a customer base of fewer than 250,000 combined wireless, wireline, broadband, and cable subscribers, and 2, serve primarily rural areas. This bidding credit will be available to eligible RSPs in the incentive auction. Applicants can seek an RSP bidding credit or a small business bidding credit, but not both. To determine whether a provider has fewer than 250,000 combined subscribers, the Commission will follow an approach similar to how it attributes revenues in the small business bidding credit context and will determine eligibility by attributing the subscribers of the applicant, its controlling interests, its affiliates, and the affiliates of its controlling interests. There are a few exceptions from the general attribution rule for RSPs. First, for RSPs that are an existing rural partnership providing service as of July 16, 2015, adoption date of the Part 1 order, the Commission created an attribution exception and will determine eligibility for the RSP bidding credit by evaluating whether the members of the rural wireless partnership each individually have fewer than 250,000 combined subscribers, and for those types of rural partnerships, the subscribers will not be aggregated. The Commission will also allow RSPs to form a consortium. For an RSP consortium, the Commission will not aggregate the subscribers of each of the members of the consortium, but will instead determine the eligibility of each individual member for the bidding credit. If the consortium wins a license, either an individual member of the consortium or a new legal entity comprising 2 or more individual consortium members must apply for the license. To better reflect the capital-intensive nature of the wireless industry, the Part 1 Report and Order also updated the Commission's gross revenue size standards that define the percentage of bidding credit a small business may receive at auction. In determining what types of bidding credits the Commission will offer in any particular service, the Commission will continue to choose among a standardized schedule of bidding credits based on the nature of and the capital requirements of the service. The Commission changed Rule 1.2110, subparagraph F2, to increase the gross revenue thresholds used to demonstrate eligibility for its small business size definitions. Small businesses with average annual gross revenues of $4 million or less for the past 3 years are eligible to apply for a 35% bidding credit. Small businesses with average annual gross revenues of $20 million or less for the past 3 years are eligible to apply for a 25% bidding credit, and small businesses with average annual gross revenues of $55 million or less for the past 3 years are eligible to apply for a 15% bidding credit. These changes should mean that more applicants may be eligible to receive small business bidding credits. These new thresholds will be utilized in the incentive auction where the Commission is offering a 25% or a 15% bidding credit to eligible entities. Mindful of its obligations to ensure that only bona fide entities receive DE bidding credits, the Commission also implemented an overall cap on the total amount of bidding credits a DE applicant may receive in any one auction. As a general matter, the amount of the bidding credit cap for a small business will not be less than $25 million, and the bidding credit cap for the total amount of bidding credits that a rural service provider may be awarded will not be less than $10 million. The Commission will use these parameters to implement a bidding credit cap for all future auctions on an auction-by-auction basis based on an evaluation of the expected capital requirements presented by the particular service being auctioned and the inventory of licenses to be auctioned. For the incentive auction, however, it is anticipated to be capital intensive. The cap will be $150 million for eligible businesses and $10 million for rural service providers. To ensure parity between small businesses and rural service providers, there will be a $10 million cap on the bidding credits in smaller markets. Basically, the Commission established a total amount of bidding credits that a winning bidder may receive in the incentive auction, but also set a market population-based cap. This means for the incentive auction, no winning DE bidder can obtain more than a $10 million in bidding credits for licenses with 500,000 POPs or less. This includes partial economic areas 118 through 416, with the exception of PEA 412 Puerto Rico, which exceeds the 500,000 POP threshold. To the extent a small business does not claim the full $10 million in bidding credits in the smaller markets, it may apply the remaining balance to its winning bids on larger licenses up to the aggregate $150 million cap for small businesses. Thank you.